Stay tuned for Retire Your Way with Dale Soutas, a leading financial retirement strategist and the founder of Soutas Financial and Insurance Solutions, right here in Fresno. Every week, Dale discusses pressing financial topics of the week, ranging from reliable income strategies to our financial markets, including Social Security, tax strategies, wealth management, RMDs, legacy planning, long-term care solutions, and most importantly, how to make sure you have enough guaranteed lifetime income to retire your way with choice and dignity. From taxes to trends to total transparency, Dale covers it all. And now, here is Retire Your Way and Dale Soutas. Welcome to Retire Your Way with Dale Soutas, your financial advisor of Soutas Financial. I am your host, Spike Spangle, with you for the entire hour. Mr. Dale Soutas, the crowd always loves you. And hey, we're going to get you a little laughter. We want to start with a little bit of fun right now. How are you doing this week?
We are doing good. Nice and busy. Recently had a workshop at Fresno State. It went really well. Yeah, just seeing lots of people and
fantastic. I want to get
moving forward.
Get some takeaways and the kinds of questions that were on people's minds. Do you ever ask it? Had people heard the radio program before? What usually gets them in the door?
Well, yeah, we have ways of getting the word out for our workshops, and we had a few that came in from the radio, which was really nice.
Awesome.
Some who've seen us in the past. One was interesting because he knows us already, and he's working for the government. I'll leave it at that. And he wanted to come in because he has a lot of other coworkers who he thinks could benefit by what we do, but wanted to get a better idea, from the workshop, the overview. And now he's, very interested in encouraging others from his workplace to come in and pick on me. I mean, to visit with us and get help.
That's
so,
fantastic.
that's a good problem. But then a lot of ones come in because we have a system through, I think it's Facebook, Instagram, that, advertises our workshops. And it's exciting. We've been doing them every other month. And our goal starting in 2026 is to put on workshops every month. We're getting to a point where we need
to
help.
Get that
help
info
get the word out. We might jockey in between some of the long-term care options that we help families with and the financial retirement income planning that we do. So, that's still being worked out a little bit, but we're looking forward to being at Fresno State once a month. Yeah.
You're blowing my brain up, though, making me think end of the year already. How many
end of the year?
How many
That's
times
right.
do we start to say, I can't believe it? The holiday season is coming, and we're in the midst of it. We're going to be changing things over. So throughout the next few weeks, we're going to be giving you some end-of-the-year reminders, things to think about. Most of all, make sure that you enjoy your family and friends, stay as healthy as you possibly can. But there are a couple of loose strings out there that we'd like to tie up, make sure they're knotted up for you before the end of the year. In fact, makes me start to think for some folks about required minimum distributions. Now, I know that's based on the number of what your accounts end up, I guess, at the end of the year. Was it December 30th?
The previous year, yeah.
Yeah, the previous year.
Exactly.
But so do we need to start thinking about that before the end of the year comes? Are we starting to, is there any advantage of getting those done early, or do you really wait and you do RMDs starting into the next quarter of the first year?
Good question.
Thanks.
So, we talked about it recently at our workshop about the RMDs, and, they're required. There's a minimum that you are required to take out of your retirement accounts, when you reach a certain age. Now, that age used to be 70 and a half. It's now 73. The year you turn 73. Now, I posed the question to the group. I said, okay, so let's say your birthday's in January and you turn 73. And I asked, so when do you have to take that minimum out? And somebody piped up correctly, by the end of the year, December 31st, correct. So you don't have to take it out the month or day you turn 73. But then, too, if that's your first time taking your minimum, you can delay it into the next year. I think it's out to April 1st of the following year. The problem doing that is that the second year, when you're 74, you're going to have both your 73 distribution and your 74 distribution all at once. And that might push your income up a bit too high, pushing you into higher tax brackets. So, we look at, how's the best time even on your first one to start taking it. But that minimum distribution you have to take by the end of, let's say, this year, if you're already 73 or past, is based on the value of your retirement account or retirement accounts December 31st of last year. And there's a certain percentage based on your attained age this year. So, and that percentage increases a little bit from year to year. If you're just now turning 73, let's say this year, then the percentage basically is 3.77%. So let's say you have to take, you have a $100,000 IRA, 401k,
Okay.
and this is your first RMD. You have to take $3,770 out by the end of this year, gross, from it. And that's going to be taxable because whatever you take out of your retirement accounts, it's ordinary income. It's taxed as ordinary income. It's not capital gains, nothing else. It's income. Uncle Sam wants his taxes off of your retirement account. So, but people are thinking, sometimes a lot of people have them set up to where they come out, let's say in December, and they get this lump of money. Some people set it up where it's throughout the year, monthly. There's many different ways you can have it set up. But by the end of the year, you have to have met that minimum at least, because if you don't, and we also have fun with this topic, if, let's say, a married couple, I usually ask the wife, is your husband ever stubborn? And
Great. Way to start the argument.
Oh, yeah, it's fun. Yeah. And she looks at him and says, she smiles. I go, okay, so let's say he has to take a minimum distribution out, but he says, I don't want it. I don't need it. You're not going to make me. I don't want to take that out. You can't make me. Okay. So let's say he doesn't take it out. Okay. But down the road, when he finally takes it out, let's say the minimum he was supposed to take out was, let's say, $10,000 for that year. Okay. And he didn't do it. Well, because he was stubborn, not only when he takes it out does he have to pay tax on that $10,000, but he has a 25% penalty. So the tax and an additional $2,500 goes to Uncle Sam because he was stubborn. So it's not a good idea to be stubborn, simply put, right?
No.
You got to take them.
I want to go back to something. This has always confused me. You said something earlier about how folks can delay the first one, meaning RMDs, until the next year. Wait, I don't get it. What if required minimum distribution? I don't understand why you don't just take it out right away, or why do you, or how are you allowed to take it out the next year? Or what's the advantage of, or is there an advantage of? Do you get it? I'm confused, Dale.
Yeah, no, there might be different circumstances for people. I'll give you an example. Let's say you just retired this year. You're turning 73, and so part of your, you had income from employment.
Okay. Yeah,
let's say. Yeah. Okay. And so your income's kind of high, and you want to delay taking that distribution this year into next year when you don't have the wages to show. Okay. Let's say. I mean, there's a lot of different reasons, but typically it's not the greatest idea because you're putting two distributions into that second year, when you turn 74, let's say.
Okay.
And it could push that income up, but it just all depends. Everybody's different in their circumstances. And
okay, but I think I'm getting it.
Yeah.
And again, let me know that if I'm staying in bounds here. So let's say you were still making, if you're retiring, but you get to 73, you enjoy what you're doing. Apparently, probably making a good income. So let's say you're making $100,000 a year. You've got a lot in your tax deferred accounts. Rather than in that year that you're 73, you're saying, you know what? I know that next year, 74, I'm definitely going to stop working. So I'm going to turn off the spigot on that income. But now you'll have two distributions based on however big your accounts are, but maybe it still could be less than whatever your salary is. So
yeah, and if you started Social Security, not all of that is taxable. You might only push up to 85% of it to the taxable column. So again, There's different
Many
reasons.
nuances. So when it comes to being a financial planner, somehow, once again, we come back to the tax conversation. Man, Dale, it's really amazing to me how many times everything circles back to taxes. Now, where do you help folks with that? Are you?
Well, what about the ones who have, when they retire, great income? Maybe they got pensions, maybe they got Social Security, maybe they have rental properties, whatever. They still have a little business that's running. How do we not pay tax on that RMD, the distribution we have to take out, but take it out anyway? So there's ways of even taking it out and not paying tax on it. That's a good
Wow. All right. Let's
good
hold that
thought
up.
to go into.
Yeah, we're going to go in
Mhm.
that into our next segment after this very short break. You can get started, though, right now on your own complete retirement plan very simply by calling the phone number. We've got folks who are standing by right now. You're not going to interrupt the program. That call is going to go over to our call center, and they will set up a time for you so you can sit down with Dale Soutas, either in the office. We can do it over the phone or over Zoom as well. We're broadcasting all around the state of California. So wherever you are hearing us from, feel free to reach out to us. 833-856-1382 is the phone number. That's 833-856-1382. Literal human beings, not bots, not those automatic call centers. We have folks who are standing by who can schedule an appointment for you. And if you'd like to learn more about Dale and his team, go to the website, soutas.com, SOUTAS.com, and feel free to write Dale there as well. Dale, the @Soutas.com. We'll be right back after this.
Get your comprehensive, complimentary Retire Your Way review by calling 833-856-1382. That's 833-856-1382.
You've heard the phrase, you don't know what you don't know, and we believe it's especially true when it comes to retirement planning. There's a lot of information out there, and it can be overwhelming and confusing. So how do you know what you don't know? Social Security, RMDs, estate planning, investment risk. These are just a few of the many areas that a financial advisor can help you navigate. But what else don't you know when it comes to retirement planning? Are you aware of all of the tax implications of your investments? Do you know how to optimize your Social Security benefits? What about your long-term care and estate planning needs? We believe that by working with a retirement planning advisor, you can uncover potential blind spots in your financial plan and gain a better understanding of your options. Don't let unknown factors potentially derail your retirement. Call Dale Soutas of Soutas Financial to uncover what you may not know about your retirement future and start your complimentary written financial plan. 833-856-1382. That's 833-856-1382. Or you can write Dale at dale@soutas.com. That's SOUTAS.com. This is Retire Your Way with Dale Soutas of Soutas Financial. Continuing our conversation, you were talking about RMDs, required minimum distributions. You have to do this if you've hit that age of 73, or you might be able to delay it to the next year.
Mhm.
But you were teasing me, Dale. You were teasing all of us, saying you might be able to take out those RMDs and not have as much of a tax consequence on it. What are you talking
Or
about?
zero tax, or even zero tax on it.
Come on.
Yeah. So the RMDs, it's the minimum you have to take out of your retirement accounts once you're currently the age of 73. For those born, by the way, if you're born 1960 or after, your minimum distribution age will start at age 75, not 73. So when you get to that age, you have to take a certain minimum out of your retirement accounts. If you keep them with employers, if we're not even go down that road. By the time you want to take them out, hopefully you're not employed. You've rolled them over to your control into an individual retirement account, what they call IRAs. So I've had many who through the years who, they don't need the money out of that RMD, or out of their IRAs. They have to take it out. And it's like, my income's really good and really high, and it's going to be put on top of my other income. I'm going to be paying, a lot of tax on that distribution. So a simple question I ask is, do you contribute to any charities? And So when they say yes, then we start figuring out, well, how much of that or all of it, if they want, can go to a charity. You've met the requirement and it goes to a charity. And if you do it properly, you don't pay tax on that distribution of the money coming out. Give some real examples here. So I have a lady she has a pensions from her husband who passed away, unfortunately, and Social Security. Her income's very good. I mean, way more than she needs to pay the bills and goof off, have fun, the paycheck, playcheck, as we talk about. So she has her RMDs made out to her church, a charity, right? So the check isn't made out in her name. The check comes from her retirement account to the name of the charity. That's the critical piece of info people need to know. If you get the money, let's say you have to take $10,000 out, and it's made out to you, you put it in your bank, and you turn around and write a check to your charity. That doesn't work for not paying tax on that $10,000 because you're not going to itemize that $10,000. Most people are using the standard deduction, so you're not itemizing anymore, and so you can't put that listed on your Schedule A. And so what we do is we have the check made out to your charity, and most custodians, most companies that hold your retirement money will do that. We just have to talk to them and make sure they do it properly. So it's made out to the church in this case. She turns around, gives that check to her church. She's met the $10,000 minimum she has to take out. Because it went straight to the charity, she pays zero tax on that $10,000. So there's some nice ways of doing it.
Yeah.
So if you don't really need it, or how about another one? I have a little lady I've known for a long time, and she, she's putting like $200 a month to her church, let's say.
Beautiful.
Her distribution is, let's say, $5,000 per year.
Okay.
And so what we do is when it comes time, $2,400, the $200 a month, times 12 is made out to her church. The balance she gets, so she only pays tax, on that balance. She doesn't pay tax on what she gives to her church. So a lot of creativeness can come, that we can help people see, which also helps lower your taxes. And so
is it just
do it
the same process if our wonderful little old gal were to take out the RMDs and just pay the church herself? I mean, isn't the same kind of tax deduction?
So let's say she takes her $5,000 out, and he turns around and writes a check for $2,400 to her church. Well, because she received the $5,000, that's going to show up on a 1099. She's going to have to put that on her tax form. She's not itemizing, so she's not going to get a deduction. She's just using her standard deduction. Of if you're single, it's what, 15,000 plus 6 if you're past 65 currently. So it's better. So it's still going to add to her overall income. But if she has the $2,400 made out to her church, she's only showing the other balance as taxable, not the $2,400. Excuse me.
Even when you think you're being charitable and you're trying to do the best thing, and I will get a deduction for this at that kind of amount underneath that threshold, it's going to be underneath your own personal deduction. You're actually better off tax-wise by taking out the RMD and having it go directly. Do you help people actually set that up for them? And here's one way I also ask you. Any kind of automatic payment like that, somebody might say, well, what if my financial situation changes? Is it hard for you to reverse it?
No,
or pause
we've
it?
had that. We've had that. I had a little lady who was having her distribution going to her church, a charity. And then down the road, her health declined, and we heard from the kids that she needs that money now to help pay for care at home. So fine. And now in that circumstance, think about it. If most of your income, if not all, is going for care, now that's a medical expense, and you're going to itemize that, and your income, your tax will be a lot lower. So we did shift the RMD in that case to her directly. We change it from the charity back to her so that they could pay for her care, keep her out of a nursing home, keep her at home, things like that. So, or even if needed, pay for an assisted living cruise ship on land, so to speak. But so yeah, you can adjust it. Maybe you don't want all of your RMD to go to charities. Maybe you want part of it. So and you can do it for a time and stop it if you want. So a lot of flexibility.
Wow. If you are looking for ways to truly maximize your retirement spending, and I don't mean by spending more, I mean maximize what you're able to spend, it really does sound like it starts with some tax strategies. If you don't have a financial advisor who's asking to see your tax returns every year to review your tax situation with you, are you really getting the full picture? Why don't you feel free to give us a call and set up your own appointment to do your RMD, your Social Security, and your income plan review with Dale Soutas right now of Soutas Financial. When you call that phone number, it's going to go over to our call center. It's not going to interrupt the program right now, and we will schedule an appointment for you, either in person or over the phone or Zoom, whichever you prefer, and depending on where you're at here in the state of California. It starts right now with a phone call, 833-856-1382. That's 833-856-1382. You know, I always like your situations that you help people with. You had, I think, a couple come in recently who seemed like they were fine with their income plan, who seemed like they were fine with their spending plan, in their 60s, ready to retire soon. And you know what? Sometimes even when you think everything is okay, you can still see some ways that you can improve your situation. What was this one about?
Yeah, it can be tweaked and improved. So, I see this regularly where people come in and contrasting views. Some people say, hey, I want to spend every dollar, down till, have a dollar left when I die, right? In other words, there's no kids or no one I'm concerned about inheriting all my stuff, so to speak. And then I have ones like this couple. They come in. Many are like this. They've done great savings. They got, the technical financial term gobs or oodles of money. They're doing okay, right? And so this couple was in their 60s. They want to retire soon, and I put all their info in, their plan. What do you need to pay the bills? What do you want to do, for fun, the play check. And I even built in a goal to keep them out of a nursing home. So I had all the figures in the planning software. I put their income from, different sources once they retire, and their assets in, and the way they even had it set up currently on the market. Most of their money was on the market, and they're going to be fine. I mean, they don't spend, tons, so their money's going to last. There's going to be a decent amount left over for the kids, and that was their goal. Their kids and their grandkids to help, leave a legacy to them, help them out. Okay. Then I got to thinking, well, wait a minute here. What if we what if we lower the volatility on the market, smooth the ride out, number one? And what if we did use a tool that gives them a little bit more income on top of, let's say, Social Security and any pensions? I think it was only Social Security. That way, if they have their income dialed in, those other assets can still be protected and still grow. And it made a huge difference. I mean, initially it was showing, let's say, at age 100, maybe on the high, risky level, 3 to, 20 million left over. Ooh, that's exciting. So when we smoothed the ride out, they still had millions left over because we implemented a tool to protect their income, which allowed them to, have their money working harder through the years for that purpose of legacy. And they ended up with a projected higher, amount going to the kids and grandkids. So
let's review exactly how we can try to make sure that you have some left over even, and the whys behind that when we get back after these messages. We'll talk exactly about the tools and how you put that together. Right now, you, as one of our radio listeners, can call that phone number and get started on your own review with the team here from Soutas Financial, 833-856-1382. More of Dale Soutas right after this.
For your own tailored written financial plan for your retirement, Call Dale Soutas of Soutas Financial at 833-856-1382. That's 833-856-1382.
Social Security is easy, right? The question is, should I take it sooner or later? Well, there are dozens and dozens of ways to take Social Security if you're single, and even more if you're married. This one-time decision can also affect how much you pay in taxes, how much you receive in lifetime payouts for you, and possibly your spouse. You could increase your nest egg by tens of thousands of dollars just by being informed. Unfortunately, the Social Security office is not allowed to give you comprehensive financial planning advice. You've paid into Social Security for decades. Don't you want to make sure you optimize your retirement income? Sure, there are tons of online calculators that will tell you how much you will receive from Social Security. Now, you need to build that into a retirement income plan with all of your assets. Get your own tailored, no-cost Social Security income strategy with the team at Retire Your Way and Soutas Financial. 833-856-1382. That's 833-856-1382. Or you can write Dale Soutas at dale@soutas.com. SOUTAS.com.
Are you worried about taxes eating into your retirement savings? By engaging in savvy tax planning, you might be able to create greater tax efficiency in your retirement plan. At Soutas Financial, our team of retirement planning specialists can help you explore tax-deferred and tax-free investment options, as well as strategies to help potentially minimize your tax burden in retirement. Don't let taxes derail your retirement plans. Let us help you create a tax-efficient financial plan and work towards maximizing your savings and minimizing your taxes. Call Dale Soutas of Retire Your Way and the team at Soutas Financial today to learn more about our tax planning solutions. Call 833-856-1382. That's 833-856-1382.
Welcome back to Retire Your Way with Dale Soutas of Soutas Financial. You were talking about a solution of a family who it sounded like they had a great amount of savings. Congratulations to them, and thank you for doing all of their own hard work for themselves. And that they were going to have enough income, yet you were just saying how you were then even thinking about implementing tools to where they could not only have maybe what they have right now, also saved at the end of their life, literally out to the age of 100, but maybe even more left over. What's the why behind that? What's the leftover amount for?
Well, okay, so we get people coming in. Maybe they don't spend a whole lot. They did well savings. Their Social Security, what are the other income sources are plentiful. So I simply ask, well, what do you want all this money to do for you? And sometimes they say, well, really, I'd like it to help our kids and grandkids. So, with this one, I was looking at, they're going to be fine. I just, as I thought about it, if I was them with that goal of helping the kids and grandkids, what would I do different, or would I even do anything different? And so I started playing with the program. I was putting in, okay, well, what if we use a little bit of this, a little bit of their retirement savings, and put it in to produce some additional guaranteed income? How would that change the picture? And at the same time, instead of the roller coaster, the big highs and lows of the stock market, let's smooth that out a bit. They can still have money on the market, have it available, but just, you don't need to, be making 20% or shooting for the moon, because you got to, be willing to lose it too, right? So I was looking at it that way, and I thought, okay. And it was amazing how by smoothing out the ride, providing a little extra guaranteed income, they had more money along the way. The other thing that I was pointing out to them is that not only can it be there way down the road when the wife passes away after or around age 100, that's the plan age I usually put it in, but what if you could help them out along the way before you die? With this plan, your income's solid. Now you have all this excess, it's not like they had millions even to start with. They had a decent amount, but it would keep growing, but they would have ability to even help the kids or grandkids out while they're alive, see them benefit instead of just hope they benefit when they
Yeah.
die. So they're just some neat
Yeah.
neat strategies. Just the more I get into my family's heads as far as what they want to do, the better, I can do it, work up the plan, based on what they want to do. Not just what everybody else did or, their neighbors or
Well,
coworkers.
exactly. And that's to find out exactly what are their goals, their aspirations. And first, so
Mhm.
when you have things covered, like being able to have our own spending plan and being able to do the things on the bucket list, travel or not, and then make sure that you're covered for you had a
Mhm.
lifespan up to 100. That's fantastic.
Mhm.
And say, well, then the next thing is kids or grandkids or legacy. And yeah, just
Yeah.
leaving that after your age of 100, or maybe enjoying it while you're alive, whether it's together, whether it's seeing them accomplish goals like helping the kids get to
Mhm.
college or, buying that house or whatever it might be and helping evaluate what those things could be.
Yeah, and so, to help ones understand when they come in, what's it like?
Mm-hmm.
Okay.
Mm-hmm.
Well, our team initially, the first visit, we refer to it as a discovery visit. Okay. We want to know what you're about. It's not just what money you have and income you have or looking forward to have down the road. It's what do you want your retirement to look like? I've been using this analogy more so lately. If you said, hey, Dale, you're a building contractor. I want you to build my dream home. You're going to come in and I'm going to ask you, well, number one, where do you want it? How big, how many rooms, what do you want it to look like and be like? I'm going to get all that detail before we talk about what it costs and do you have the money and all that. I'm going to get that picture first. So when you come in, it's more, what do you want your retirement to look like? What do you want to be doing? And then I get to the money side. So it's important to know what people want. So our team initially will gather that information, and it might be that we give you a little bit of homework because not everybody knows right off the top of head exactly what they spend on their bills every month because some things come in annually or every 6 months. So we have some forms that we can give you to help you come up with your monthly spending. We don't like to use the word budget, right?
Mm-hmm. Yeah.
So
Yeah.
that
But
plus
and for our
you sh-
listeners who haven't listened to us before, budget is like a diet. Budget feels like, oh boy,
Mhm.
they're telling me what I can spend, and
No.
and what happens to many diets, most diets, you end up binging and shooting way
Mhm.
over the mark.
Exactly.
So we just want like a spending
So
flow. What things do you want to build in there? And you're saying
yeah,
you've
so
got
we
tools.
see that and we build your plan with
Hmm.
3% inflation at least throughout the wife's age 100. We also want to know, what do you want to do for fun? Travel, spoil the kids, grandkids, sporting activities, whatever. Get a RV, let's say, glamping. That's a fun word lately. People, oh, I'm not going to go camp. I'll go glamping. Okay, great. So we want to get that feel for what you really want your retirement to be like. Then we go to work, on putting together, with what you have currently and or what you have coming as far as income down the road. How do we make it work? And then you come back for your, we call it a roadmap. Okay, let's
Hmm.
look at a rough draft of your retirement income plan. Because typically we're tweaking it even right there in front of them. They'd say, oh, well, because a lot of times I put in,
Hmm.
they say, I want to travel or I want to do all these fun things. And on average, let's say it costs $20,000 a year. Well, I'll usually put their uh, play check. I'll usually try to double it and see, will their money last if they do twice as much fun, right? Um, there's no such thing as too much fun, according to my wife. So the point being is, we want you to enjoy retirement, all the things you really want to do, even if you're a homebody. Well, how do we deal with the overall picture and stuff? But we get to know you as a team. Then we build out your plan. And, if it makes sense, great. We can charge to do the plan, but I don't want to, and I don't have to. So we don't charge to do a retirement income plan. There's no need because if it's not your cup of tea, it's kind of a slap in the face to pay for something you're not going to use anyway. But and not everybody needs us to take them by the hand through it. You might just need a pat on the back. Go tell your spouse, yes, everything's okay, or let us help you tell your spouse that everything will work. Because most people are coming in to find out, am I on the right track? Will what I'm thinking work down the road? And it's really nice to be able to show people, yes, you're going to be fine. Maybe there's a little something they're not thinking of. Like, how many times do I see people, they own real estate and they don't have a living trust? So that real estate isn't going to their beneficiaries as they're thinking, the kids or grandkids, whoever. It's going to go to the state's probate system. So we will coach them to see an attorney. We don't get any money doing that because the attorney and us are not licensed the same. We don't share money. I just want to make sure they have, the right, wording in their documents and things like that. But we're not just, here to say, come on, here, throw all your money with us. I mean, I have a deposit slip I can give people, but
no, stop it. We don't want a red flag there. You just brought up something, and it made me think of an article I just saw recently, and I think this would be a great idea for us to talk about next week. It was something incredibly simple for people like me, and it was literally it was a full page. And it was, it was literally symbols and had all of the different kinds of trusts and what they do. Now, you just said specifically living trust. And there's all different kinds. And that's, I think, where things get confusing. But as a financial advisor, why right now did you bring up, they don't have a living trust? What does that mean?
Well, a living trust or a trust, a revocable trust, they're all the same. I don't think there's any such thing as a dead trust, but anyway. But the point being,
nice.
Yeah.
Okay, I did not see that one coming from you. You beat me.
You're welcome. So anyway, a trust basically, if mom and dad own the property and they set up a trust, it's mom and dad's trust. Whatever they name it, doesn't matter. Mom and dad are the trustees. They're in control of the assets in that trust. The trust is just, for all practical purposes, a fancy will, okay? So it just keeps the property out of probate, and it carries it as a private family matter to the family. It doesn't go in front of, everybody's eyes who can look at a probate case, because that's public record. And then it just a smooth transition. And yeah, trust, it would be fun to talk about. If you say go, I'll even pick on an attorney friend of mine and have him sit in on our show next week, if that makes sense.
Oh, that would actually be a lot of fun. Hey, we got to take a very short break right now. Call the phone number if you would like to get started on your plan. There's all different kinds of trusts. If we are thinking about leaving a legacy to the next generation, what kinds of things do you want to make sure that you take care of? How do you want to take care of the tax situation? How do you want to make sure you transfer as much as possible? These are conversations that you can have with your financial advisor, Dale Soutas, just by calling the phone number and setting up your appointment. 833-856-1382 is that number. Soutas.com is the website, Soutas.com. Get started right now so you can sit down with the team here from Soutas Financial. More of Retire Your Way right after this.
For your own tailored written financial plan for your retirement, call Dale Soutas of Soutas Financial at 833-856-1382. That's 833-856-1382.
Will your investments provide you the income you need in retirement? Are you losing purchasing power of your savings to inflation? Simply stated, if the daily cost of goods and services is 8% higher and you are earning 4% in your investments, that money buys you less of what you need. Right now is the time to act to be certain you have an income strategy that overcomes the effects of inflation. Get your own complimentary retirement income review by calling Dale Soutas of Soutas Financial and retire your way. 833-856-1382. You might have the savings you need today to weather this storm, but how will inflation affect your nest egg 5, 10, or 15 years from now? Discover the peace of mind you deserve. Call and ask for your complimentary, no obligation retirement income review from Dale Soutas of Soutas Financial. 833-856-1382. That's 833-856-1382. Or you can write Dale Soutas at dale@soutas.com, SOUTAS.com.
Are you worried that you waited too late to start your retirement planning? That you waited too late to start saving? At Soutas Financial, we believe it's never too late to start planning for your future. We can help you develop a personalized retirement plan that is tailored to your current needs and goals. The team at Soutas Financial will sit down with you and provide an evaluation of your current path, including your investment strategy, tax planning, and risk management approach. We'll help you identify potential areas for improvement and work with you to create a retirement plan that is designed to help you work towards having financial security and peace of mind in retirement. It's not too late for you to get started with Soutas Financial. Call us today to schedule your complimentary retirement planning session. We believe we can help you get on the path to financial security and peace of mind in retirement. Call Dale Soutas and the team at Soutas Financial to get started on your own complimentary written financial plan. Call 833-856-1382. That's 833-856-1382.
Welcome back to Retire Your Way with Dale Soutas of Soutas Financial. If you'd like to learn more about the team and schedule your own appointment with your financial advisor, you can go to the website, soutas.com, SOUTAS.com. Dale, as you know, I always love your storytelling. Who have you helped out this week and where from?
Well, recently I had a couple come in from actually quite a ways out from Fresno, I think it's about an hour and a half out of Coalinga, and a real nice couple. And what's nice is, I know she would like to retire right away, and he wants to keep going. He enjoys what he does. He has a business, and he's enjoying what he does. And, basically, the way she put it, he's going to keep working until he dies. But we need to look at a few things. And as we met, I uncovered some basic things they needed to work on. For instance, they need to have a trust. They have a property that would get stuck in probate if something happens to both of them. But ideally, they would like that to go to their children. So, I coached them on talking to an attorney, gave them a referral to one I know for 24 years, so that's good. But really, as we talked more, we're looking at not only helping her move her 401k, get it positioned, to be able to really keep going how she wants to do, but also his business. I realize he's overpaying taxes. And you might think, well, how's he doing that? Sometimes people don't realize if you're the sole proprietor of a business, it might be wise to look at setting up like an S-corp. And that was, something I saw that would help him to minimize a lot of tax and get more ability to write off more of his expenses. So, again, if saving tax is on people's minds, there's ways to do that. So, basically the S-corp is one of them. And it was interesting because the attorney met with us at the office briefly to sign something, and then we'll gather some information on setting up and coaching him on a S-corp. And to do that, we're going to obviously get involved with the CPA and make sure he understands the nuts and bolts and pros and cons of doing something like that. But having an estate plan was number one, but also it led right into the fact that, you're paying too much tax, basically. You can minimize your taxes down the road.
Okay. So let's talk about, we're talking about the minimizing the taxes down the road. This is going to change, though, kind of the business dynamic of what the group is doing. Can you do that once your business has already been established? You can change what the tax features of it is?
Well, yeah. I mean, going from a sole prop where every bit of income. So let's say you're bringing in $500,000 of gross income,
Okay.
and you write off half of that, all your business expenses. So you're showing Uncle Sam $250,000 of taxable income. Then what you could do with an S-corp, from what my CPAs are showing me. In fact, I called my CPA with them in my office, say, hey, would this be a good example or a good candidate for, to look into restructuring how he has his business set up. And he said, well, yeah, and here's why. So of that 250, he would be able to now be on the payroll and take a paycheck and have Social Security, deducted. Instead of paying Social Security on that whole 250 that would come normally to his tax return, he would be paying, Social Security when you're self-employed is 16%, and people employed are thinking, well, no, it's only 8%. Yeah, because your employer pays the other half. So being self-employed, sole prop, and he's going to go from 16%. He's still going to pay 16%. Let's say he takes $50,000 as a salary, paycheck. So he pays 16% on that $50,000, but then he'll be able to write off other things that he normally can't under, as a sole prop. But now that $200,000, let's say that still comes through to his tax return, but it comes on a K-1 and he doesn't pay any Social Security tax on that. So do the math. That's $32,000 in this rough example that he would save just on the Social Security tax alone, and not counting other deductions he could take. So to do that, it was interesting because when the attorney came in, I said, hey, I just got off the phone with the CPA, and he suggested it. And he said, oh, well, yeah, there's a lot of good reasons to do that. And he recommended
why didn't
talk to his CPA.
Yeah, why didn't his CPA suggest it before? That's what I mean. That's what these professionals are supposed to do. That's why we encourage you that talking with a financial advisor isn't just putting together a portfolio and seeing if you can be and stay retired. It's all of those aspects of your life. And that's what I think Dale finds so interesting, the entire team does, is we want to get to know you. And what are the parameters of your life? And if we can find ways to improve the financial situation, that gives us great joy. That's why Dale gets up with a smile on his face every day, right? You're coming to the office.
Well, yeah, it's
who you
fun.
can help.
I mean, it's creative. And no day is the same as the previous. Every day is different, and everybody's different and challenging in a good way. It's not like, oh my, that's so hard to do. No, it's fun because when I get stumped, I have got a team I can pull from outside of my office, even resources galore that can help me to look at things. And in this example for this couple, if they're able to save, $20,000, $30,000 or more in taxes, well, what can that do for their savings and their retirement? Obviously, they got more money to spend on themselves, the kids, the grandkids, or whatever they want to do. So, we tend to look at the whole picture, and I'm not going to pick on their CPA. I don't, they were doing it. The CPA could have suggested, hey, you might want to look into setting up a S-corp. No, I'm happy doing what I'm doing. And the CPA is not going to force anybody like us. We're not going to force somebody to go do it. We're just going to get them up to speed, educate you. What are your options? What can you do? And will it help you? That's the beauty of it. And sending somebody to the attorney, sending somebody to their own CPA or our CPAs, we don't get paid to do, from them. We're not licensed as an attorney. We're not licensed as CPAs. So we don't share money. I just want to make sure my families are taken care of properly. And if it means, referring them to somebody who can help them with other things, even we discovered too, this gentleman just started Medicare. He signed up for a Medicare Advantage plan. And I was thinking, well, the difficulty he's having is not all of his doctors work with that particular plan. I said, you might want to look into having a supplement instead of a Medicare Advantage plan. And the cost isn't really prohibitive in their case. And so, we're looking at different options, or recommending he look at some options to improve their Medicare health insurance plan too.
Yeah, and that's what we're always trying to do is there a way that we can improve your situation that you might not see? Folks, you might not even know that there are different options out there for you. But why don't you have a financial advisor help you look through it and just have a conversation? And that's what Dale and the team like to do, is let's get to know you and see how we might be able to improve your situation. And that is no cost to you as one of our radio listeners. You can call the phone number, set up an appointment. I totally forget. What town did you say this couple was all the way in?
all the way from Coalinga. They're actually, yeah.
Wow.
Which, again,
Wow.
is way out there.
Way
I
out
used
there.
to go out there years ago, once in a while.
Yeah, we're reaching as many corners of California as we possibly can. So if you're hearing our voice right now, we'd be glad to sit down with you or talk to you about your situation. We can do a phone call, we can do a Zoom, or you can come on in to Dale's office and you'll meet the team and we'll find out about you and we'll talk about next steps to see what we can do to maybe improve your situation financially, preparing you for retirement. 833-856-1382 is the phone number. That's 833-856-1382. Dale, for a couple like this, I mean, you're talking about business planning, changing them from a single proprietor to an S-corp. What are the next steps? I mean, are you an attorney?
Nope. Nope, but I know enough to refer him to and get the proper help. And look at it this way, too. Let's say she retires. He's going to keep working. Even if he retires, we don't stop there. We're going to keep working with them hand in hand, throughout the changes. I had somebody recently, her circumstances changed, but we're still working on the plans, always moving forward, right? In other words, lives change, circumstances change. We have to be able to adjust and adapt as our families' lives change too. So, but just getting the big picture in first and getting all the little things dialed in can be helpful, but we don't stop just at the initial.
All righty. So for our listeners out there, we want to let you know that you can get started right now to get your complete retirement review, your written financial plan, your tax review, estate planning conversation, heck, even your business conversation. A lot of folks consider what their private business is as their retirement plan. That can be risky alone. Why don't you give us a call so you can know if you can be and stay retired, not just for yourself, maybe for your spouse as well. 833-856-1382. That's 833-856-1382 is the phone number for you to call. That's going to be all the time that we have this week, but folks are still going to be standing by to schedule appointments for you. Or if you'd like to, you can schedule on your own. Go to Soutas.com, Soutas.com. For Dale Soutas, I'm Spike. We'll be back again next week.
This is not endorsed or affiliated with the Social Security Administration or any U.S. government agency.
Investment advisory services are offered through Foundations Investment Advisors, LLC, Foundations, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Any discussions of specific strategies are for informational purposes only and have been provided to help determine whether they may be appropriate for your specific situation. If applicable, the primary goal is converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. Each individual investor's situation is different, and any ideas provided may not be appropriate for your particular circumstances. Comments regarding a particular client's experience may or may not be the same as another client's experience and is not an indication that any client or prospective client will experience the same or a higher level of future success or performance. Foundations only transacts business in those jurisdictions where it's properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Nothing herein constitutes a recommendation that any security, portfolio, or securities or investment strategy is suitable for any specific person. No legal or tax advice is provided. Please review your retirement, tax, and estate legacy planning strategies with a legal tax professional before transacting or implementing any strategies discussed herein. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. This is not endorsed or affiliated with the Social Security Administration, any federal Medicare program, nor any U.S. government agency. If applicable, we do not offer every plan available in your area, and contacting us at the phone numbers provided herein will direct you to a licensed insurance agent. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all your options. All rights reserved.